Welcome once again to my YouTube channel, and on this second video I'll be explaining everything you need to know about the smart money concept, how to use the smart money concept to find a good trade like these ones you see here on my screen, to find a very good trade, how to go about it with all these different time frames. So it's not something hard the way people take it. It's not something that hard. So I will be explaining, and you just need to pay attention to understand the whole thing from scratch. So first of all, we are trading smart money concept, and I explained in the last video that smart money concept was a strategy built for traders to read the market and interpret it to filter out every manipulations before they get their trades. You understand? So that's what we are doing here right now. I'm taking you through the process from scratch. All of this, I'll also be telling you what all of this mean right here. So firstly, I'm going to give you a raw example of how the market structure is in the market. And the first thing we need to look at are these higher highs, higher lows, lower highs, and lower lows. This is the four components of the market structure that we use in SMC trading. And like I said before, market structure is a trend following tool. Traders read and follow based on how the market move from bullish to bearish. Remember, when they say market is trending, market is either trending to the upside, which is bullish, or trending to the downside. So market structure is the trend following to traders read and follow. You don't make it, you read it and follow, because we are not the market makers. So we read it and follow. How do we read it? First of all, you need to understand how to spot if a market is bullish or bearish. So if a market is bullish, what are the things that we need to see to say, okay, this market is bullish? That's what I will explain. That's where all these higher highs, higher lows, lower highs, and lower lows are coming into play. So pay good attention to this. This is the main thing in the whole market structure. So let me just catch something very fast. Yeah, this is what I'll be using to explain market structure for you. This higher high, higher low, lower highs, and lower low, how market structure is formed. That is what I'm explaining right now. You understand? So first things first, we go for the higher highs and higher low. Higher highs and higher lows are created when the market is trending to the upside. When the market is bullish, the market creates higher highs, series, multiple higher highs and higher low. So let me just label this thing very fast, and so you'll be able to understand what I'm saying. Higher highs, 18, all of these are higher highs. Then higher lows, these are higher lows. So you can see there's something important about these higher highs and higher low. I'll be explaining it when I get to this break of structure. You understand how higher highs and higher lows hold. You understand? Then this is for the bullish market. This is for the bullish market. Market is trending upward, bullish. Bullish market. You can see it. So this is for the bearish. Let me label it too. lower lows, series of lower lows for the bearish market. Downtrend, this is a downtrend and this is an uptrend. Everything is just names, but they are all pointing at the same thing. Lower highs, these are lower highs. So when the market is bullish, remember, it's creating series of higher highs and higher low when the market is bullish. So this for the bearish. Yeah, when the market is bullish, trending to the upside, it's creating series of higher highs, higher low, higher highs, higher low, higher highs. That's how I keep going. Then lower lows and lower highs are for bearish market. So you understand, that's the basics for the market structure. So now, how do you know that the bullish market is valid or the bearish market is valid? We know that the only way we know that a bullish market is valid is when we see break of structure to the upside. These are break of structure, breaking previous highs to the upside, coming back to retest the zones that were created before the expansion. You can see here the market was breaking series of higher highs. This point here, when the market came here, just like the way this one was now, you see that there's nothing here. That was how all this one too was formed. It broke above here, break of structure. That's what we call break of structure. You can see it. BOS is just basically break of structure. When the market creates series of higher highs and higher low, this is also a structure, a higher low structure and a higher high structure. So when the market keeps breaking structure to the upside, the market is bullish. And when the market keeps breaking structure to the downside, the market is bearish. The same thing, just opposites to each other. You understand? The same thing. So when the market is creating series of higher highs and higher low, it always leave clue like footprints where you come back to take trades for confirmation entries. You come back here to take good trades and buy. When the process, when the market is coming back after breaking structure to these zones, the market will be creating, is called retracement or pullback. It's called retracement or pullback. These are called retracement or pullback. On the higher time frame, you can see this retracement as a sell trade. So you need to understand this market structure very well, so you can be able to identify everything on all time frame without making any mistake. So when the market creates series of higher highs and higher low, and it come back to respect the zone that was created when the expansion broke above the structure, you know that the market keeps going. Then there's something you need to pay attention to. You see, the sell too is the same thing. It has to break structure to the downside for it to be a bullish market, a bearish market trending to the downside. That is the criteria for being a bearish market. So but now there's something you need to pay attention to that we call change of character or market structure shift. If this market comes back here and does not respect the zone that was created and break below it, come back to respect the new zone that was created here, now the market is creating series of lower lows, lower high. This point where the market switch from bullish market to bearish market is what we call change of character. Change of character, which is CHOCH. Chalk. Some people call it chalk, boys. The full name is change of character. You can see it here. And market structure shift, you can use market structure shift or change of character. The two are pointing to the same thing, but they have just a slight difference between each other. I will explain it later, but they mean the same thing, but there's just a slight difference. The slight difference is on the time frame. When we get to live example, you understand what I'm saying. So the process where the market is switching from bullish market to bearish market is called change of character or market structure shift. So you see now the market broke below here. It's still a break of structure, but this part is not going to be a break of structure anymore. It will be a market structure shift or change of character, because it signifies that the market switched the trend from bullish trend or uptrend to bearish trend, which is downtrend. That's how we get. Then we come here, look for entries. There are different ways we look for entries. It's simple to get to the entries. When we get there, you understand how to get your entries. Then from here, this is how we sell on SMC. You understand? That's how we sell and get trades. Like you can see, this trade now is currently running. This is gold, currently selling. The way this one too is, you can see the market was going, creating series of higher highs, higher low, higher highs, higher low. Now you can see the same thing here, change of character. You can see this is a live example, change of character. This was the higher low. Remember, higher low, higher low. The market broke below and it's become change of character. Look at it here on the live example. So there was something here that the market, the point of interest here is a fair value gap. What is a fair value gap? This is a fair value gap. Fair value gap. Let me explain what a fair value gap is. A fair value gap is formed from 3 different candlesticks like this. You can see this is a very clear example. A fair value gap is just a space in between those 3 candles. This space has to be filled. Market always come back to fill this fair value gap. Just this, anywhere you can see them. Look at this. This is a fair. You can see I spot it here. Daily fair value gap. You can see this market came to fill this fair value gap before it continued downward. So we use fair value gap as points of interest where we enter trades. You understand? So there was a fair value gap here. There was a small fair value gap here. You can see it. That's the fair value gap that this market react to. And you can see after creating series of higher highs, higher low, there was a shift here, which is the change of character. So market came back to retest that change of character. Now the market is selling. That's how SMC works. Very simple. If you understand this concept, it will be hard for you to lose trade. The same thing here. The market is respecting everything as it's breaking structure to the downside, but once you notice that this market switch from creating series of lower lows and lower highs and now break above the previous lower high, comes back to retest, then you know you have a bullish market now. That's how we just switch to buy and sell every time. This is the same thing, just opposite to each other, but it's the same thing. So you need to, that's why I'm making this video. You can go back and watch the video over and over again to understand the concept, how I explained from beginning to this point. If you understand this particular market structure, you just be assured that you know how to trade the SMC and start to pick trades for yourself, but you have to practice. So now this is just a rough sketch of how SMC works, which is smart money concept. So now let's go and complete this thing. Mitigation. Let me complete this abbreviation, this little things you are seeing here. This mitigation and order block are where traders pick their trades. Like here now, this place is my order block. You can see this line is where I use as my order block. The order block means that is where I'm taking my entry from. That's what order block means. When you hear somebody saying order block is the point, the price level. You can see there's a level here, prices the price level where the person is either taking buys or sell. You can see there was another block here too that I used for this buy, and now there's another block that I use for this sell. So that's what other block means, where you are taking your entries from. Then mitigation means when the other block has been tested and the other block has played out. You can see the market went up, came back to this other block. Now the market has played out, so now this other block is mitigated. When the other block has played out, it's called mitigation. This other block is mitigated because it has played out to the expectations of the market. You understand? It has played out. That's what we call mitigation. Same thing here, this other block has been mitigated. Then there are other blocks that are not tested. Those are unmitigated other block. So you can find unmitigated other block are like when this trade has not come to tap this other block. Now it is not mitigated. That's an unmitigated other block. But now that it has tapped and start to play, it is now a mitigated other block. That's what mitigation means. You understand? So with this little explanation of how the market structure work, we'll be in the next video. I'll be explaining how to pick trades, how to analyze from higher time frame to lower time frame. Analyzing from higher time frame to lower time frame to pick your trades is what we call top down analysis. It's called top down, and top down analysis is simply taking analyzing your markets from higher time frame. You can see it's very rough and doesn't have meaning on this weekly time frame. Daily time frame is saying something different. Every time frame has their own market structure. So on the next video, I will be explaining how to use all of this time frame, combine them together to get your trades on lower time frame like this that we trade every day. And I'll be explaining the type of traders and the type of trades. There are scalpers, day traders, and swing traders. So I'll be explaining what all of those things are on the next video, and how the traders use them. What are the difference between a scalper, the difference between a day trader, the difference between a swing trader, and also a position trader. Now you understand what market structure is. Now on the next video, we'll be using that concept to pick trades, how to use that concept to pick trades. So make sure you don't watch this video like a film. Make sure you watch it carefully, understand everything I am saying. If you don't understand, replay the video so you can get a better picture of what I'm saying before you move to the next video. Don't just watch the first one and watch the second one, watch the third one straight like you're watching video. Make sure you understand everything that I'm explaining. So in the next video, you will be seeing how I pick trades from higher time frame to lower time frame, which is the top down analysis. So see you guys on the next video.